All right, thanks everyone for tuning into the Farm Progress Virtual Experience Land Values Breakout Session. Today joining us are Todd Kuethe, Associate Professor and Schrader Chair in Farmland Economics at Purdue University, and Jim Jansen, Agricultural Systems Economist and Extension Educator at the University of Nebraska-Lincoln. Kicking us off today will be Todd Kuethe. Todd, do you want to go ahead and get us started?
Yeah, sure. I was going to talk to you today, mostly focusing on the results of our annual survey we do here at Purdue University to get a good handle on the farmland markets here in the state of Indiana. So if you want to take me forward. So our survey started in the early 1970s. We've done it annually, and it's conducted each June. So we survey a variety of professionals around the state who touch on farmland markets as a big part of their daily activities. So rural appraisers, ag lenders, farm managers, also some farmers in there as well. And we collect information about their current land values in the state, in their region. So we ask them about specifically the county where they have expertise. And we ask about current market, so that would be June of the year. We also ask about the previous December, and then ask them to make some gauge about the coming December. And we split land into 3 different quality grades, so top, average, and poor quality in each county. And those are based on the respondents' reported belief of the long-run corn yield productivity. So, top quality land in some parts of the state is a little bit different than top quality land in other parts of the state. So it's really kind of that local top. And then we also ask about cash rental rates as the other big part of the puzzle. Yeah, if you want to go forward here, sorry. So the big news for this year is that land values are up. So if we would have told our respondents a year ago, in 2019, that we'd see land values up, 3 to 6%, depending on what part of the state you're in, people would be very excited. And so prices are up. That's generally a good thing for landowners. I should also mention here, I'm just going to speak mostly about the state level averages. And we also publish 6 regions in the state, so a collection of about 15 counties, which is available in the full report. But basically this year, unlike some previous years, so we had this high run up in land values, and then a decline starting about 2014, which is a pretty modest decline, sort of a plateau at times. And a couple times in recent years, it really depended on what part of the state you live in, what your quality land looks like. And so we'd have some places where prices are falling a bit, some are rising, but it sort of averaged out to relatively flat. So one of the reasons I didn't talk about the regional results here today is that we basically saw this same pattern, which is increases of somewhere in that 3 to 6% range over 2019. If you go forward one slide, you can see here, this is our history going back to 1970, and this is for the average quality land at the state level. So the gold line is the nominal, so this is the price that we see every year. The dashed line, the dark gray line, is inflation adjusted. So we're controlling for what is that price difference as a result of general inflation. So again, reminding the inflation is just the idea economists use that the price of everything goes up over time. And so if we want to put it on level footing and say, well, what's the 2020 value? So we can see our prices are up a bit over the last year, still down from those peaks of 2014. But if you look at a historic average, even controlling for inflation, we're well above sort of traditional average. Now, one of the things is prices, feel a lot better on a run up than they do at the run down, the same level of price. And so prices are still high in that sort of long run expected, even though we've seen a bit of a dip. Now, the interesting thing about 2020, I think if you go forward one more slide, is where we, to break it down, so we ask about December and June, and then the coming December. Most of that gain that we've seen over 2020, from June 2020 to June 19, actually took place in the second half of 2019. So between June and December of last year, prices increased, 6 or 7%. Since December, we've seen prices tail off by about 1.5 or 2% around the state. So prices have moderated slightly. Some of that maybe has to do with the differences in the economic conditions, obviously, with the coronavirus pandemic and the uncertainty we have there, how it's changed our purchasing patterns. And it changes the amount people are willing to sell land onto the market. we've seen some slight reductions, and they're actually predicting that to continue into the end of December of this year, which we'll touch on a little bit later. Okay, so if we go forward, okay, so we ask our respondents, what are the major drivers of land in your market area? This is similar to what Jim will talk about with his survey. We ask them to rate them on a scale of -5 to +5, where if things are really negative, you give it a -5, it's really bad. Things are really positive, you give a +5. So if we look at the positive influences, why are land values creeping up, or at least held steady over the last couple years and through 2020? The big things they point to are low interest rates, right? So we've had some changes in Fed policy over the last several years. Particularly, we had a rate cut again this spring. And I know that the Federal Reserve is debating what to do about short-run rates, but also the long-run mortgage rates are very low, and so the cost of borrowing to finance major purchases like farmland are very low, which makes it easy to capitalize any kind of return you have. And so that low interest rate is really, I think, is what's really driving farmland. People also have been pointing towards the low returns to alternative investments. So a lot of farmland owners are either farmers themselves or people that are within the rural area looking to make some investment. And really, where else are you going to park your investment space right now? I mean, we have high returns in the stock market some days, and then we have very low returns the others. It seems to be very high volatility.
You're cutting out a little bit. Can you back up a little bit?
Sure. Where do you want me to start on this slide?
Back to inflation, if you would.
Okay, so yeah, so we have should I go on the low interest rates, or?
Yeah, you can go back to low interest rates.
So we ask our respondents, what are the major drivers of land values in their area? And one of the things that they point to continually over the last several years are low interest rates. So the Fed has made a number of changes, including short-run rate cuts this spring with the coronavirus. But also if you look out across the lending curve, those mortgages, long-run securities, is where we see rates very low. And so that really helps support farmland, reducing the cost to borrow, allowing us to capitalize any income we have at a very favorable rate. The other one is just the low return to alternative investments, right? So a lot of farmland purchases are farmers themselves, and the rest are usually people from the rural areas or from the state looking to make investments. And when you have such volatile returns in things like the equities markets, I mean, farmland, although the returns are somewhat lower often than we see in other investment spaces, they're very stable returns. So that sort of low alternative investments, low return to other investments really helps farmland. And then the biggest one is just the limited supply. So for the last 3 years, our respondents have continually said that the volume of land going on the market is less than the year before. So we're seeing a real tightening of supply. I think this will continue into this next year, particularly as the coronavirus pandemic continues to go. People are kind of in a real wait and see attitude, hesitant maybe to make larger moves. So I think we'll see people that are kind of maybe holding on to land to wait to see a year or two what's going to happen. And that really helps support the price, right? So just basic economics, that as the supply is reduced, the price tends to go up. And then the bigger one, the one that's always kind of a mystery to me, is they always point to inflation, which is puzzling because we essentially have no inflation, and we haven't for a long time. So there's definitely a period in the 70s where very high inflation helped support farmland values. But so we're kind of still this inflation puzzle. But there's a general belief that farmland is a good hedge against inflation, right? If inflation is just the price level of everything that we buy in the economy going up, things that produce commodities that are used across a lot of goods generally hold their value. So things like farmland, but also things like mines or natural resource extraction tend to be very correlated with inflation. On the negative side, they basically all point towards low returns, right? So we still have low commodity prices for both crops and livestock, low net returns. We do have some farmers that are increasingly in liquidity issues, right? Where we don't have that reserved capital from high commodity prices that we saw, 5 or 6 years ago. And so maybe, there are still a lot of farmers out there with cash willing to make investments when they see opportunities, but they're also being a little bit more cautious, I think. And so that's really kind of putting a downward pressure on the land. Just really just what can we expect to return? So if you go forward to the next one for me. Oh yeah, so here's what we have sort of in terms of our projected. So what we saw coming out of the end of 2019 into this summer were prices slipping somewhere between 1% and 2%, depending on quality grades across the state. And our respondents generally expect to see similar or slightly higher declines going into the last half of the year. So I think a lot of it has to do with the economic uncertainty, also the low returns we still see in agriculture. A lot of our supportive income has come from policy payments for the last couple of years. That's always a thing that farmers aren't as willing to bet on that as a guaranteed source of income as much as they prefer putting commodities into markets. And so I think that sort of gives that sort of general negative look. And then I think the last section we have here is about what we see in terms of rents in the state. Oh no, this is so our cash rental rates. Again, cash rent is up anywhere between 4% and 5% around the state, and that can seem a little bit puzzling based off of the spring that we had. But I always want to try to remind people that a lot of times the rates are set in the fall and in the winter. And if we think back to last, November through February, we were coming off of a harvest that was much better than people would have expected last summer. We also had a lot of resolution coming with trade and other policy uncertainty. So I think that put a lot of optimism into to farmers thinking that they would be able to make some opportunity to increase their income. And so the last bit here, the last graph we go forward, is just one of the ways so here, cash rents, again, we've seen declines in both real and nominal values starting about 2014 or 15 as the income started to decline. But we've seen this, this year is the first sort of back uptick into cash rental rates. So if we go forward one more, that's where I thought we were going to be. And this is the ratio of cash rent to land value. So basically, what percentage of a return can you expect to have from owning farmland and cash renting it, right? So the easiest way to make money when you own farmland is just to cash rent it out to someone else. And so a lot of people that are farmland owners or potential farmland investors look at this, what's our expected return? And so with our slight increase in land values and our increase in cash rents, we've really held steady at about a 3% return since 2015. So this is really where that sort of plateau, we've reached kind of an equilibrium point. We're still below where we would be sort of long run average, but it's been really stable over the last several years. So yeah, thank you very much. And if you want to see our full report of what we found here across Indiana in terms of cash rent and land values, I encourage you to take a look at the Center for Commercial Agriculture where that report is posted.
All right, thank you, Todd. Next is Jim Jansen, Nebraska Extension Agricultural Economist, and he's going to tell us a little bit about the Western Corn Belt.
All right, Tyler, well, thanks for having us today. Never had a chance to actually take a look at Purdue's report very deeply, but we have a very similar setup in terms of the type of individuals that we survey, as well as similar trends in terms of the results that came out this last year. So if you want to go ahead to the next slide, we'll start taking a look at a few of these things. Similar to Indiana, I believe, we divide the state. We have 93 counties and divide the state into the 8 agricultural statistic districts, or some folks still refer to them as crop reporting districts. The state of Nebraska, really there's the eastern third of it and then the western 2/3. And the western 2/3, relating this to the kind of the Western Corn Belt, the western 2/3 would probably follow the trends of states like Colorado or Kansas better than the eastern third, where the eastern third would probably follow the trends of a state like Iowa or possibly even Missouri a little bit more. So what we've seen across the state, similar to Indiana, we've seen a slight increase in the market value of land that we estimated as February 1 compared to February 1st of 2019. And we did note a few areas of the state where basically a 1% change up or down would basically be unchanged. But we also noted some areas in around the Omaha and Lincoln metro areas in that East District, we noted a slight increase of 5%. But for overall, for the state of Nebraska, we noted just a slight increase up about 3%. If you want to go ahead, we'll see on the next slide here a little bit more of a historical perspective. The Farm Real Estate Survey here at Nebraska began in 1978 and has continued on since then. And we put two things up on this slide. The blue line is the average market value of land, and we did not adjust it for inflation in this slide, but it does provide a degree of perspective in terms of the run-up that we've seen in the last decade, and or I guess even the last 15 years now, and then the slight decline we had over the last 5 years until 2019, and then we note the slight increase there. And the number one crop, or the only crop that we grow in every county in this state, is corn. We obviously grow corn, soybeans, wheat, other small grains, and specialty crops, but corn's kind of the big barometer of the term of profitability or revenue potential in this state. And we're seeing a slight decline in the estimated market value of corn, and there's been various kinds of disaster or financial assistance payments from the USDA that may be coming out this year. But during the fall of 2019, a lot of our survey respondents reported the marketing facilitation payments providing a degree of liquidity or solvency to the farm operations. And if you want to go to the next slide, Tyler, we'll see here the other thing that we talk about in addition to the earning potential of an asset is the financing of interest rates, as Todd had indicated too. The ability, and we use the 10-year treasury yield rate here, and there's various reasons why we use that, but you have, as an individual seeking to buy a land, the ability to go out and purchase land for a fixed period of time at probably some of the lowest real interest rates we've seen in recent history. You know, on interest rates and savings accounts, CDs, you're doing good to find 1% right now. So that's maybe one factor that's providing some degree of stability to the ag land markets, our current interest rates, in addition to housing or other assets that we find on farms like vehicles, machinery, whatever it might be. If you want to go ahead and hit the next slide, Tyler, we'll see one thing that we have seen. We may not be playing football this year, but the one thing Nebraska was #1 in, and trying to kind of tie this together for the Corn Belt starting out there in Ohio to Colorado, is real estate taxes. And this is an issue that the state legislature, when they reconvened this past summer, they did provide some protection or a small degree of relief that may grow over time depending on how the legislation is fully carried forward. But farm real estate taxes is one of the negative forces on real estate, because as a retired landowner having to pay real estate taxes in this state relative to surrounding states, it's one challenge that a lot of people are facing. So this is a policy issue that many folks are taking a look at. And if anybody would like to find more information on this, about a year ago, Agricultural Economic Insights did a pretty nice article on this. So that's where this information came right here. I'm going to go ahead. We'll see on the next slide here. Taking a look, it's kind of a tornado graph here, but if the line is on the blue lines are on the right-hand side, it's leading to land values increase. If it's on the left-hand side, it's a slight decrease. The main point being a lot of concern that thing that was placing pressure on the farm real estate market, as you might say, obviously crop prices, farm input costs. It's not surprising to see those there, but force #1 and #4, real estate taxes, current real estate tax levels or future property tax policies. We did get something pulled off this year, and we hope that that legislation will help provide some relief to many landowners. On the positive side, some of the things Todd indicated, non-farm interest and investments. I mean, if you have money right now, where do you put it? Making much more than 1% or whatever, given the level of risk or volatility in the investments. So that's kind of where we're seeing very similar trends to Indiana as well. So if you want to go ahead. Well, with respects to cash rent, now Indiana probably has a little bit more uniformity across it than our state, but 2020 cash rents, we just noted a slight decrease in the southwest Nebraska, but basically across the state, cash rental rates were fairly steady. Nebraska has a great degree of cash rents. We can go from $20 to $30 a acre in the western part to over 200 in the northeast or eastern portion. And if you want to move forward one more slide, Tyler, we'll see here one thing that was brought to our attention by our ag policy folks here at UNL. When it comes to, excuse me, that'll be in another slide or two, but one thing I wanted to note, I agree with Todd's statement. There are a lot of cash rents that are set during the winter time, maybe up till roughly when people know where their crop insurance guarantees are. I'm still surprised based on the phone calls we take. I still think there are, even if you agree to a rate, there may be some adjustments being made. And if you note Nebraska kind of in the right-hand side of the slide there, and you look at cash rents, how they fluctuate during the year, I do think we might be seeing a little pressure or maybe some degree of consideration being provided to operators, hopefully, given the current financial plight many people are facing, especially if they set their cash rents before, say, March 1st, and we didn't see the full repercussions of the pandemic on the markets. So Kansas City Fed noted some trends, and based on our call volume on our farm real estate program here at UNL, I would say they would follow somewhat similar to this as well. So if you want to go ahead, Tyler. The highest renting land value land class we have at the state in the state of Nebraska are irrigated rental rates. You know, in the eastern part, slightly up, slightly down, overall fairly steady. Marketing facilitation payments made during the fall of 2019. Last I checked, they were around, I think it was $960 million. So that definitely provided a cash infusion or a cash injection to our farm real estate industry here with operators and that. We noted also a slight decline in the western part of the state. Some of the reasons that were noted was concern expressed in the specialty crop production sector out in the western panhandle. So we do see a wide variety, but I would call cash rental rates for cropland to be overall fairly steady in our state. If you'd like to go ahead, Tyler. Cow-calf pair rental rates, another thing that we note here. When it comes to cow-calf pair rents, Nebraska has some of the highest cow-calf or grazing land rental rates we see in the Central Plains states. And I don't have the percent change on here, but this is for one cow, one calf for 1 month during the summer grazing season. The majority of the state, kind of around that $50 a month, is still a fairly fixed standard unless you're out in the way western part of the state where a little bit different competitive market forces out there and along with stocking rates. But overall, we've seen cash rental rates were steady on cow-calf, and obviously there's been some, there was a period when cow-calf prices were down. They have recovered some for the calves that we expect to sell this fall. But once again, the current price situation provides some pretty challenging circumstances for many folks. So if you want to go ahead, Tyler. Kind of the news story that I picked out of the Kansas City Federal Reserve, and you'll notice on these slides on the second line there, I note the name of the survey and the publication date it came from. But drought, it appears to be a big issue, especially in the western tier of the Corn Belt. And Nebraska, if you would, this slide's roughly a month old now, but if you would update it, you would see that the drought has grown additionally in Northeast as well as the western part of the state. And, you know, drought coupled on low prices, usually we'd hope if we had lower prices, we at least have favorable production circumstances. And that's one that a lot of folks are struggling with right now. So that's what's displayed in the right-hand side. You know, the repayment rates on obligations with respect to various kinds of debt, something that we're concerned about, but we hope some of the financial assistance payments of various kinds through the USDA will help offset some of that. So if you want to go ahead, Tyler. Yeah, so that kind of rounds out what I had to visit with the folks today about, but there's been a lot of forces changing and evolving. There are some similarities across the Corn Belt, but there are also issues that are a little unique to each Indiana and Nebraska. So it just kind of depends where you're at in the United States and what kind of forces are influencing the farm real estate market and what we anticipate may be guiding it in the future as well.
One of the things that I wanted to ask both of you guys was, are we mostly seeing, we're seeing land values kind of remain steady right now. And based on all the projections that I've seen, we're looking at land values holding steady even after in a post-COVID environment. Is that mostly a result of low interest rates, or are we seeing the same trend that we're seeing in Nebraska all across the board, that there is actually a scarcity in the land market where we have a lot of interested buyers, but not as many interested sellers? And also, I wanted to ask about the role that government payments might be playing in holding values steady.
Do you want me to take this one, Jim, or you want to go first? Or
Go ahead.
so I always think of the best model that to kind of understand farmland values in aggregate is just your basic Econ 101 or Intro to Finance net present value, right? So we take the value of any asset is the value we expect to get by owning it, or the income we expect to get by owning it, and then we discount that over time, right? So we have some preferences to have money now as opposed to money in the future. So, the future is uncertain. We may not trust that we get there, or we have inflationary pressure that'll erode those future earnings, buying potential. And so we discount the future relatively heavily. And that's basically, that sort of basic model tells us that the things we should look at are the income potential, how we discount those income, and then also if there's any expected income growth. And I think the people that are positive about farmland in the medium and long term, it really comes down to that idea of income growth. So the idea that the world is getting more people in it, and the people are getting wealthier and consuming more calories and more protein, and how that drives the demand for, the commodities that we produce here in the Corn Belt. And then I think the other big part of it that you mentioned is, the interest rate and the cost of borrowing. So we're now a decade into very low interest rates historically. And so the cost of maintaining or capitalizing that income into an investment gets really easy to do. And so I think, even though we've seen, lower returns historically, that, comparing an historic average, we're still in a pretty decent position. Incomes are tightening, and I'm sure people would love to go back to, the commodity prices we had a handful of years ago. But the idea that, we're going to continue to increase our technology and look for more customers for agriculture, more uses for agricultural products in that future demand. And it's really, if we look at the data on ownership, most people that own farmland own it for about 30 years. So it's a very long-term investment horizon. So those people are looking at, what can I expect to earn it over the next, multiple decades. And I think that's still that, the history bears out that it's a safe and stable asset, maybe not high growth as we'd see in other kinds of investments, but that I think is really doing a lot to keep it up. And then people that own it, if you own it without debt, your only real expenses are the taxes, which I know Jim says that in Nebraska they're quite high, but across the country, it's a relatively low cost in terms of annual taxation. So there's not a whole lot of incentive to give it up. So I think that's one of the reasons we're seeing this sort of tight supply.
Thank you, Todd. Jim, do you have any thoughts?
Well, you gotta wonder about Todd's comments. You throw a decade of basically free or low cost money at an economic issue that we've been trying to correct, and you gotta wonder if inflation will eventually impact something. And currently it appears to be fairly negligible, if that even. And low interest rates, the marketing facilitation payments made in last year was one round that provided a degree of financial certainty to operators they may have not been expecting otherwise. In 2020, we're looking at the CFAP program, the Coronavirus Food Assistance Program, which I don't know exactly where those numbers are coming in at, but I would assume they will be fairly favorable with respects to the financial assistance provided to operations to offset the decline in commodity prices due to, to a degree of disruption in trade or supply chain issues. Looking forward to 2021, if you look at the marketing year average price for the crop that's currently growing, that'll be marketed over the next year here about, especially for like the PLC or the price loss coverage program, On corn, it looks like payments on a per bushel basis may be 55 to 65 cents a bushel multiplied by whatever your base is on your property, along with an 85% payment rate. But the point being, a variety of financial or disaster assistance programs have certainly provided a degree of liquidity to operations. And I think coupling that with low interest rates or low alternatives as well for it beyond the current interest rate situation. From what I can tell, if you take a look at that 10-year Treasury yield rate, well, last time I looked at it before we've seen it drop so much again, you know, looking at certain lenders, you can add 2 3/8 to 2 5/8. And that's roughly what you're looking at for around a 20-year ag land loan after a dividend, if it was through that type of a financial institution. But the point is, you know, taking out an ag land loan for 4.5%, 5%. I mean, that's pretty low thing, but you've got to be able to. So the certainty of that, along with the outlook that people are having when it comes to buying these assets, 30 plus years, whatever, you know, there's still things happening in the farm real estate that I wouldn't feel too worried about it at this point. I don't think it's going to be the phenomenon we've seen in the 1980s necessarily. I think things are a little bit stabler, and I think the lending standards are probably a little bit more favorable with respect to requiring, you know, the 5 basics of 5 C's of credit or whatever. But I think more conservative lending practices and other things as well. So that's kind of where I would look at things.
Okay, thanks again, Jim and Todd. Thank you for listening to the Land Values Breakout session.